Ratings agency Moody's has upgraded Kenya's long-term credit ratings to B3 from CAA1 for both local and foreign currency, and that includes senior unsecured debt, with an outlook that is stable. According to its latest data, the upgrade was prompted by Kenya's increase in foreign currency reserves, which rose from $9.2 billion at the end of 2024 all the way to over $12.2 billion by the end of 2025. East Africa's largest economy returned to the international market last year with 2 Eurobond issuances, raising a total of $3 billion. Moody says that move reflects improved domestic financing conditions too, and is pointing to much lower borrowing costs and strong investor demand for government securities, which the agency says have enhanced Kenya's ability to meet its fiscal needs locally and reducing its reliance on external borrowing. Let's bring in Churchill Ogutu. He's an economist at the IC Group. He's joining us live on the program tonight to help us pass this ratings upgrade from Moody's. So, Churchill, one of the things that Moody's cited in its decision was a more stable exchange rate. Now, the central bank has come under fire, especially last year, for how they've kept the dollar-shilling rate at 129 to the dollar as part of their process to accumulate reserves, even as the US dollar continues to weaken. So, looking ahead, what external factors could impede the central bank's ability to keep the exchange rate stable?
Yeah, thanks, Rama, for having me. As you clearly pointed out, the stability of the shilling against the dollar is coming on the back of weakness in the US dollar. And that speaks also to the fact that the CBK has been accumulating foreign exchange reserves and also the foreign assets in the banking system. Looking at where we were in December 2022, it was around $2.3 billion. That's of the whole banking system, CBK, and also the banks. And also, as of the end of last year, it's skyrocketed to $9.2 billion. So there's an increase in the foreign assets within the banking sector, which has also led to CBK to accumulate dollars, and hence the stability between the US dollar Kenya shillings rate. So the opposite of that, in the event that we see dollar strengthening amongst reduced risk of sentiment that you're seeing in the US as an economy, all these factors that have led to the US weakening sort of resolving themselves, and that will poses the biggest risk that might potentially happen, because now it will necessitate the Central Bank of Kenya now taking the opposite side of this trade, essentially now selling the dollars to be able to support the shilling. But looking at where the FX reserves are at the moment, you spoke to $12.2 billion as of the end of last year. We're expecting that the inflows that might come over the course of this year, not just the typical foreign financing inflows, but there's this big Safaricom divestiture, which could realize potentially $1.6 billion to FX reserves, because it's coming in hard currency. So we're looking at an outlook of some, at least some significant FX reserves by the end of this year. So that speaks to what exactly is happening within the FX market. And that speaks to the fact that there's an foreign exchange interbank market, and potentially the CBK is actually intervening with a set price in mind. So I think that's, in my view, is what has led to the stability. So even if all these factors are playing out, there's a particular price that the CBK is coming into the market with.
And I'm glad you raised the questions around foreign financing inflows, because some of the concessional multilateral funding that Moody's was referring to in that statement that they put out yesterday still hasn't materialized, right? Halfway into the fiscal year. The Kenyan government had penciled in a $1.2 billion loan coming in from the World Bank. The World Bank tells us actually, no, it's a small amount. It's $750 million. That's not materialized. There's a $1 billion loan that was penciled in as a sort of food security, debt for food security swap. That hasn't happened yet. What explains the holdup on those two?
Yeah, for sure. The annual borrowing plan sort of alluded to $1.2 billion coming from the World Bank, $750 million this particular quarter, and then $450 million in the second quarter. But now World Bank came and said it's actually coming to $750 million. But as far as the World Bank development policy financing is concerned, there are what we call indicative targets or prior actions that the Kenyan authorities ideally should have implemented before the disbursement of these funds ensue. We have the conflict of interest bill that one was passed, but there are also a number of reforms that are still have yet to be completed before now we can actually see the actual disbursement from the World Bank. So that sort of brings the memories that we had with the IMF, the non-completion of the final disbursement. So it's all boils down to the reform agenda by the authorities. As far as food security swap is concerned, I think there are it's one of these complex transactions that you are seeing, and it involves up to three legs for this to be properly executed. On one side, there's now the law funding or concessional funding from one of the multilateral lenders. So that's one. On the other side, you find that this multilateral financing has to go to liability manage some of these expensive loans, be it Eurobonds or syndicated loans. And then the savings that is accruing from having a low multilateral financing and then having sort of done the liability management. So this savings is now what is going to the food security. So it's a bit complex transaction. So I can imagine it's quite entailing for it now to hammer a deal by this point in time. So, but I think that potentially, as far as annual borrowing plan is concerned, this should be coming in this financial year. But it's still a complex transaction to execute. Hence the delay in this food security swap.
Kenya still has external debt service on an annual basis of at least $2.5, in some cases $3 billion a year for most of this decade. That's yet to come. What other proactive measures can be done to reduce those liabilities beyond what the authorities have already been doing, right? Last year, we saw them coming into the market, raising $3 billion in Eurobond, use some of the proceeds to do bond buybacks, same thing in 2024. But beyond that, what else can be done?
I think honestly, the room for having other maneuvers is quite limited. Because you think about it, the liability management operations that were conducted were ideally looking at even some of the debts, reducing the debt servicing cost, and also some of the maturities. And the maturities that were being targeted were on the Eurobonds and also some inclusion of syndicated loans. So that's because of the nature of some of these commercial loans. So that was where liability management operations were quite reasonable. The other side, we've seen also extension of some of these maturities on the bilateral side, the conversion of the standard gauge rail loans from dollar currency to the yuan currency. So that also involved some element of even maturity extension. Some of these loans, ideally, we should have completed paying them by 2050, 2035. But from what we gather is that that has been extended to around 2040. Yeah, 2040 thereabout. So I think that's pretty much. I don't see scope for other liability management or maturity extension of some of these other loans outside these loans, which I can say, quote unquote, they are quite problematic. Which I think that ideally that's the template that they'll pursue to be able to smooth the maturity curve, at least in the near term. By the liability management on the commercial debt and also a bit of some of these expensive bilateral loans.
And on that question around, the transparency of how these transactions are conducted, that brings me to the last question, because Kenya's government is also engaged in securitization efforts, right, of multiple levies. There are plans to securitize the railway development levy. It's effectively an import tax on anything that's brought in for domestic use, trying to use that to raise $4 billion. Another $1 billion that aims to be raised through additional securitization of taxes on fuel. Aren't all these policies just building up liabilities that are much, much harder to scrutinize?
Yeah, definitely. At the end of the day, you'll find that contingent liabilities keep piling up as we pursue all this manner of securitizations we've seen. counter argument to that is you can say that some of these securitizations, some of them now end up in the capital markets in the form of corporate bonds, but also the liquidity around that. There's still some transparency issues around even the process of coming up with some of these corporate bond issuances. So yeah, you're spot on in terms of pointing out the transparency. Ultimately, the case in Ghana, where also they had some securitization bonds, and in the event that there was the tail risk that happened, the default that happened, that necessitated now restructuring the debt in the central government, and also some of this securitization, securitized bonds in the case of Ghana were also brought to the picture to be restructured. So yes, we may just sort of kid ourselves that, okay, they are off balance sheet transactions, but in the event that some of these tail risks crystallizes, that's when we realize that, the contingent liabilities are something that we need to pay attention to. So that's something that the transparency and also the treatment of some of these contingent liabilities is something that needs to be, we need to have some laser focus attention on them.